Hi, welcome to Money Wisdom. I'm Eric Hogarth, and today's question is, how do I spend my retirement savings without triggering a tax penalty? Tax planning is a huge part of retirement planning. Not just how much do you have, but also where does it make the most sense to take that money from? Now, the general rule under normal circumstances is you do not want to spend your retirement money before the age of 59 and a half. I say general because this is not everyone, but it's most everyone. So you really don't want to access money in the 401k or the IRA or the Roth before you retire, because that money you've saved is to provide for you in retirement. So if you spend it before retirement, you can see the problem with that. But you do have to be mindful as you go to draw money out of these accounts, are you taking the money out of the right ones, both from an investment standpoint and a tax standpoint? It's enticing sometimes to pull money out of a Roth. Well, if we take it out of a Roth, we don't have to pay any taxes on it. But usually that's a mistake, because every dollar that you make in a Roth, you don't have to pay taxes on it later either. So you really want to let that money grow as long as possible, because, are taxes going to go up? Probably. So that'll really benefit you in the long term. Similarly, if you have a traditional retirement account where you pay taxes on all of it as you draw it out, well, again, are taxes going to go up? Probably. Is that account going to grow? Hopefully. So maybe it does make sense to spend that money earlier, pay taxes on it now to avoid paying potentially more in the future. So it's not just how much money you have invested or how it's invested, but what are the tax ramifications as you pull that money out? Social Security. Most people are going to pay taxes on some of it. Again, some people are going to get penalties because they draw the Social Security early, or they access that retirement money, the wrong way. So be having these conversations to get input on not just do I have enough money, but are we thinking the right way and have the right plan for how do we best draw that money out to make sure you keep as much of it as possible.
Why does this come up so often, actually so much more than it used to? Well, you probably know why. You've got friends that have been asked to retire early. You've got all kinds of early retirement packages out there being offered by big companies. And maybe even you're asking, hey, should I retire early? With 2020 behind us, is it really time to think about what our lifestyle is? Do I want to work as hard as I was working before? Do I want to commute? Do I have enough money in my investments, in my retirement plan, between my investments, Social Security, maybe a pension I'm going to get, so that I can retire and maybe only work if I want to work, but not at the job I've been working at? It's a great question, and this is really a question based on what you want to do just as much as it is what you can do. So there's two questions to be answered. Number one, what do you feel like doing? Do you feel like retiring? Because if you don't feel like retiring, it doesn't make any sense to see if you're prepared to retire today. Obviously, in your financial plan, you want to make sure you're prepared for when you decide to retire, whether that's a year from now, 2 years from now, 3 years from now. But if you want to retire today, which is the first question you should answer, then the next question obviously is, can I do that? Can I make sure that I can invest my money and get guaranteed income sources like Social Security in such a way where I'm not going to run out of money before I die? So it's, first of all, the answer to that question, should I retire early, is do you want to? And then the second is, can I do that? And I would also I guess there's another nuance in there, which is, do you really want to retire, or do you just want to leave the job where you're working at? So what I would ask you to do is, if you're asking that question, should I retire, explore what you want to do. Forget about what you can do first and figure out, do I really want to retire? Why do I want to retire? And then we can sit down with you and figure out, okay, what are the things that I need to make sure are in place so that I do not run out of money in retirement, so that I can maintain my lifestyle in retirement.
There's a few answers to this, but the simplest answer is, if you think you're going to be in a higher tax bracket when you use the money in your retirement plan than you are today, you should probably convert. Why do I say that? Well, if you can convert money, if you can take money out of a retirement plan today and to pay taxes on that money, and then take that money and put it into a Roth IRA where all the money is going to be tax-free in the future, and you can have a higher tax bracket in the future, which means you've got a lower tax bracket today, then that's really good news. Let me give you an example. Let's say I'm in a 25% tax bracket today and I take the money out of my retirement plan. Let's say it's $100,000. And I take that $100,000 and put it into a Roth IRA. I'm going to have to pay taxes on that $100,000. At 25%, it's $25,000. But now that $100,000 is in that Roth IRA, and it's going to grow and grow and grow if invested properly. And maybe it becomes $400,000 by the time I'm going to use it in retirement. Now that $400,000 is completely tax-free. If I was in a 30% tax bracket of retirement, I would pay $120,000 of taxes on that $400,000 if it was in a traditional retirement plan. If it's in a Roth, I pay zero taxes. So general rule, if you're going to be in a higher tax bracket when you pull money out of a retirement account than you are now, it makes sense to possibly convert over to a Roth. There are a lot of other factors involved. I personally like the idea of having flexibility in retirement where I can have Roth money and I can have traditional IRA money, and I get to decide each year where to take the money from. By the way, for those of you that don't quite understand what a Roth IRA is compared to a traditional IRA or a traditional 401k, when we put money into a traditional account, we get a tax deduction. When we take the money out of that account, we pay taxes on the money. In a Roth, when we put money into a retirement account, we don't get a tax deduction, but when we take money out, it's all tax-free. So the key here is the growth. If the money grows, and it grows a lot, wouldn't it be better to spend the money tax-free than to pay taxes on all that growth? So it becomes a little complex. Some of you understand what I mean by all these terms, and some of you don't. That's okay. Ask us for more information if you want. But the key is, if you think you're going to be in a higher tax bracket when you use your retirement money than you are today, it may be a real good idea to convert over to a Roth today. Great question. Why is this a good question? Because taxes are so important. So many retirees, so many investors focus on getting a little bit more of a rate of return, and at the same time, they're losing maybe a third, maybe more of their return to taxes. So what if instead of chasing a higher rate of return, we get the same rate of return, but get to keep more of it? Very, very important, right? Doesn't that make sense? It's not what you earn, it's what you keep. That's the old saying. So let's talk about tax strategies for retirement income. The first thing you need to think about when you're planning your retirement income is, who is the money for? What do I mean by that? Well, my wife and I, Wendy, I'm 58 years old, so we're getting close to the age where I could retire. Don't plan to, certainly for the next 10 years, but I could retire. And we've been fortunate. We've lived below our means. We've saved a lot of money. So there is some money that it would be almost impossible, unless we really ramped up our lifestyle, to spend. So we have some of our money that's for children and grandchildren. I have one on the way, by the way. And some money that is for us. Well, that money that's for children and grandchildren, I want to set that money up. That's not for Wendy and I, but for someone else, in a way that it passes to them in the most tax efficient way. So those types of assets might be stocks where they get a step up in cost basis. They don't have to pay the tax on the profit. It might be Roth IRAs. It might be life insurance and a trust. We own all of those things. The money that we want to use for our retirement income, ideally we don't pay taxes on it, but sometimes that means we pay taxes today so that we don't have to pay taxes on a larger amount in the future. And what am I talking about there? I'm talking about really having the conversation on whether you should convert some of your IRAs, 401ks, any type of traditional retirement accounts over to a Roth IRA. Right now, as I record this in 2021, we are at a fairly low tax rate historically on a personal level. Very likely the taxes will go up. And if they do go up, they're going to hurt those of you that did a great job saving for retirement. So you may want to do a conversion, pay some taxes today so you pay less taxes in the future or over your lifetime. Also, if your kids or grandkids inherit money from an IRA, they now have to take all the money out within 10 years. Everything has to come out within 10 years. So there's no opportunity to stretch those taxes over your their lifetime. So what am I saying here? What's the bottom line? The bottom line is if the money is not for you, you should take action right now. We're at low tax rates. Set it up so the people that are inheriting that money can enjoy that money to the utmost, which means maybe reducing their taxes in the future. If the money is for you, then we want to decide, should you spend money from stocks and bonds that are not in retirement accounts first, or should you spend money that are in retirement accounts and leave those stocks and bonds alone? So this segment really is to get you thinking about those different categories, but I want you to start with that question, who is the money for? Because for some of you, you want to use your taxable money today so that you pass on tax-free money in the future. And I think this question comes from the standpoint of, should I invest differently when I'm retired versus when I'm working? And that's a very insightful question because, if you just walk down the aisles of your grocery store and you pick up Money Magazine or Kiplinger's, actually I don't even know if money exists anymore, but you'll read a lot of commentary on what are the best mutual funds to own and the best stocks, the 5 stocks you ought to own today. And what's bothersome to me about those articles is it doesn't take you into account, your unique situation, your ability to tolerate the ups and downs of the stock market, which some people can tolerate, most people cannot. So what types of investments should retirees have? Well, first of all, I want you to understand the concept that once you are retired, you're no longer adding money to investments. So there's not an advantage to the market going down. When you're working, the market goes down, you're adding to the investment, so you're buying shares cheap. When you're retired and you're taking money off that portfolio, now it's the opposite. You're having to sell more when things are low and sell less when things are high to get that monthly check. So we want to invest, for the most part, in retirement to get a reasonable rate of return, but to spin off monthly income. Think of it as a pension plan. What is a pension plan's job? It's to send out a monthly check to the people that money was promised to. Think of investing that way in retirement versus just for growth, like you may have in your 40s and maybe early 50s. What types of investments? Well, you could use stocks, you could use mutual funds, you could use exchange traded funds, which are a type of mutual fund. You could use bonds, and there are variances within those categories, but I want you to think of investing in retirement more as investing for a reasonable rate of return, but also steady income. So typically people de-risk their portfolios in retirement. Now, I know this gets a little technical. There are subcategories that I haven't gone into. If you have any questions, feel free to contact us. We can help you. We have resources we can send out that explain the different types of ingredients that can go into building a good income portfolio.